Silver, $59 plus. Peace deal crumbled overnight. The most dangerous weekend setup of 2026, 48 hours ago. A ceasefire that was supposed to hold for months collapsed in under 2 weeks. And while most of the world was watching the headlines, something else was happening, quietly, inside a vault. 87 million ounces of silver, sitting there, waiting, while 112 million ounces of paper contracts prepared to demand it back. That gap is not supposed to exist, not at this size, not this close to delivery day. And right now, as missiles cross borders that were declared peaceful just 10 days ago, that gap is about to be tested. This is not a story about silver going up or silver going down. This is a story about what happens when a market built on paper promises meets a physical world that is running out of patience. Monday morning will tell us something most people are not prepared for. Stay with this video until the end, because by the time it's finished, you will understand exactly what is converging this week and why it has never converged quite like this before. Now, before we go further, I want to ask you for something. Not a big thing, just a small thing. You know how, in the old days, when something important was happening, your father or your grandfather would tell you, "Pay attention. Remember this. This matters." That's really all I'm asking. If this channel has given you something worth remembering, worth understanding a little more clearly than before, then do an old-fashioned thing for me. Press that subscribe button. It costs you nothing, but it tells me you want to keep learning, week after week, together. And one more thing, I'd love to know where in the world you're watching this from. Drop your city, your country, down in the comments below. Let's see just how far this conversation travels. Now, let's get into it. It was just past midnight on the West Coast when the news began moving through trading desks faster than anyone could verify it. The United States military had struck Iran. Not a warning, not a drill. Actual airstrikes, confirmed by U.S. Central Command, hitting missile storage sites, radar installations, and a facility on an island that sat at the narrow mouth of the Strait of Hormuz. For 10 days, the world had believed something different was true. A memorandum of understanding had been signed in mid-June. Diplomats shook hands. Markets exhaled. The narrative was simple and clean. The conflict was over. The waterway was reopening. Oil would flow freely again, and inflation fears could finally rest. That narrative had a price tag attached to it. Silver, which had climbed above $100 an ounce earlier in the year, came crashing down toward $55. Investors who had held through every previous dip suddenly watched their conviction tested in a way it had never been tested before. But the ceasefire was never as solid as the headlines suggested. Just 2 days before the American strikes, something quieter had already happened in those same waters. Iran's naval forces had broadcast a warning over open radio channels, the kind every commercial ship in that region monitors. The message was simple. Only specific routes were safe. Anyone who strayed would face consequences. Hours later, a drone struck a cargo ship near the coast of Oman. 2 more vessels were ordered to change course by armed patrol boats. Within 48 hours, an international maritime escort program, one that had only just launched, was suspended entirely. 57 ships and more than 1,000 sailors were left waiting, uncertain whether the safest path forward still existed. Then came the American response. Then came Iran's countermeasures, striking U.S. positions, and additional strikes launched toward neighboring Bahrain. 10 days. That is how long it took for an agreement, built to prevent exactly this kind of escalation, to unravel into the very thing it was designed to stop. A senior Iranian parliamentary official offered an explanation that, to outside observers, sounded almost absurd. He insisted this was not a violation of the ceasefire at all. He called it ceasefire management, a phrase used to describe a drone strike on commercial shipping, followed by foreign bombs falling on Iranian soil for the first time since the agreement had been signed. Whatever this was being called internally, the market had already made its judgment. Oil prices had fallen sharply in the preceding weeks, more than 30% from their spring highs, based entirely on the belief that this waterway was open for good. That belief had pulled the U.S. dollar higher. A stronger dollar had pushed real interest rates up. And rising real yields had triggered automated selling across precious metals, silver included. It was a chain reaction. Oil down, dollar up, yields up, silver down. Clean, logical, and almost entirely dependent on one assumption holding steady. That assumption no longer looked steady at all. What very few people watching the headlines understood was that the reopening of this critical shipping route had never actually been complete. The shallow coastal paths used by smaller vessels were functioning. But the deep central channel, the one needed by the largest oil tankers in the world, the ones that actually move the volume markets depend on, remained obstructed. Naval estimates suggested dozens of explosive devices were still being cleared from those waters, a process expected to take weeks, not days. So the price of oil had been reflecting a partial recovery, not a full one. And now, with shots fired in both directions over a single weekend, even that partial recovery faced a new and uncomfortable question. Was it still safe to use the routes currently open, when armed patrols were actively warning ships away from them just days earlier? That question would not be answered by Saturday's headlines. It would be answered Sunday night, when markets in Asia opened first and began pricing in everything that had just happened across 2 days of silence and confusion. For now, all anyone could say with certainty was this. The story that had justified silver's collapse was no longer the story that was actually unfolding on the ground. You said, with part 2, start more unique 800 words. While television screens filled with footage of strikes and statements, a much quieter story was unfolding inside a place almost nobody outside the commodities world ever thinks about. A vault. Specifically, the registered silver holding sitting inside the COMEX warehousing system, the mechanism that backs every futures contract traded in the United States. As of the most recent reporting date, that vault held just over 87 million ounces of silver, physically present, verified, legally available for delivery to anyone holding a contract that demanded it. That number, on its own, meant little to most people, but placed beside a second number, it became something far more important. The front-month futures contract for July carried more than 22,000 open positions. Each contract represented 5,000 ounces. Multiplied out, that came to roughly 112 million ounces of paper claims, all of them carrying the legal right to request physical delivery starting on the very first trading day of the new month, just 72 hours away. 112 million ounces of potential demand, 87 million ounces sitting in the vault to meet it, a coverage ratio of roughly 77%. In an ordinary year, this gap would not raise eyebrows. Most contract holders never actually demand physical metal. They roll their positions forward, settle in cash, and move on. But this had not been an ordinary year. Earlier in the spring, more than 9,000 contracts had stood for actual physical delivery, a figure well above historical norms. Just 1 month before this current squeeze, more than 6,000 had done the same. These were not speculative bets. These were industrial buyers, manufacturers who needed real metal for real production, and who had spent months building direct procurement pipelines through the delivery system itself after struggling to source silver through normal commercial channels during the shipping disruption. Those pipelines were maturing at exactly the wrong moment for anyone betting against silver. And then there was the price gap that almost nobody outside specialist trading circles had been tracking. In Shanghai, the world's largest physical silver market, buyers had been paying a premium of nearly 10% above the London paper price throughout the entire week of the sell-off. Not 2%, not 5, 10. This was not a market behaving as though metal had become worthless. This was a market where physical buyers were aggressively competing for every ounce they could secure, even as the paper price on screens elsewhere told a story of collapse. Precious metals dealers across the United States reported something similar happening at street level. Physical silver coins and bars were selling out rapidly at the lower prices. Customers who had stayed cautious through the higher price levels earlier in the year were suddenly stepping in with confidence, buying the dip in tangible form rather than paper exposure. This divergence between what the paper market said silver was worth and what physical buyers were actually willing to pay for it has a long and consistent history. It does not last. Eventually, one side moves to meet the other. And across 6 consecutive years of structural deficit in this metal, that convergence has only ever resolved in one direction. The paper price rises to catch up with physical reality. There was also a date sitting quietly on the calendar that deserved far more attention than it was receiving. Government officials were expected to announce a new strategic framework around critical minerals and tariff policy within roughly 2 weeks, a framework that some analysts believed could formally designate silver as a strategic resource. If that designation occurred, it would do something markets rarely see. It would turn a national government into a direct competitor for physical supply, inside a market already running an annual deficit of more than 46 million ounces. One commodities analyst put it plainly to his audience that same week. When a government becomes a serious buyer in a market already short on inventory, the natural outcome is a price increase driven simply by the absence of available supply. This was not framed as speculation. It was framed as a basic observation about how supply chains respond to new, large-scale demand. So, while headlines focused entirely on falling prices and geopolitical chaos, the vault told a different story. A story about a market where physical demand had quietly outpaced physical supply, and where the gap between paper promises and real metal was about to be tested by a calendar nobody could postpone. Across trading floors and financial commentary that week, a familiar comparison kept surfacing. Analysts pointed back to early 2008, when gold had pushed past $1,000 an ounce for the first time, only to fall sharply months later, dropping by more than 30% before the larger bull market eventually resumed. The argument being made was straightforward. Silver's recent fall from its January peak looked like a similar pattern, a sharp climb followed by a deep correction, Not the end of a cycle, but a painful pause within it. There was real merit to that comparison. The broader economic backdrop in 2008 shared certain characteristics with the present moment. Confidence in the dollar's long-term stability was being questioned. Government debt was expanding faster than the economy could comfortably absorb. Inflation pressures were proving difficult to control through interest rate policy alone because they were not being driven primarily by consumer demand. These structural conditions, then and now, created fertile ground for precious metals to eventually reassert themselves after a period of doubt. But the comparison, while useful, missed something important. Several conditions present in the current market simply did not exist back in 2008. In that earlier period, there was no 6-year stretch of structural supply deficit weighing on the metal. There was no delivery deadline sitting 72 hours away, forcing contract holders to decide whether they actually wanted physical metal in hand. There was no 10% premium being paid by physical buyers in Shanghai, while paper prices told a contradictory story. And there was no vault sitting at roughly 77% coverage against a wave of contracts that had a documented recent history of standing for actual delivery rather than rolling forward quietly. In other words, the floor beneath silver in the current environment was built from entirely different material. The downside, while real and painful for anyone holding through it, appeared more structurally limited than it had during the 2008 correction, simply because the underlying physical mechanics of supply and demand were tighter than they had ever been in this market's recent history. This distinction mattered enormously for how the next several weeks were likely to unfold. Technical analysts tracking the silver chart through the recent decline had identified what is known as a double bottom pattern, a formation where price tests a low point twice and fails to break meaningfully lower on the second attempt. The most recent weekly candle showed a long lower shadow, a visual signal often associated with strong buying interest stepping in to reject further declines. Above the current price, analysts had identified a specific resistance level, a point where the recent decline would have retraced roughly 62% of its move from January's all-time high. Breaking and holding above that level on a weekly closing basis was widely viewed across institutional trading desks as the signal that would shift sentiment from cautious recovery to renewed bullish momentum, opening the path toward a higher target range that several major banks had already identified in their published forecasts. Those forecasts, notably, had not changed. Multiple large financial institutions had published price targets for silver well above current levels earlier in the year, with annual averages and year-end projections that remained, on paper, entirely unrevised despite the recent sell-off. The institutions making those calls had not walked them back because of a temporary squeeze tied to currency movements, automated selling triggered by margin calls in Asia, or routine quarter-end portfolio rebalancing. The destination these analysts had mapped out had not moved. Only the path toward it had become more turbulent, more uncertain, and considerably more dangerous for anyone forced to make a decision under pressure, with a delivery deadline now measured in hours rather than weeks. There is a temptation, in moments like this, to treat every piece of selling as a verdict, to assume that a falling price reflects falling truth. But 3 separate forces had converged to produce this particular decline, and each of them carried a built-in expiration date that very few headlines had bothered to mention. The first was a shift in expectations around future interest rate policy, driven largely by inflation data that, while still elevated, had come in close enough to forecasts that it removed an element of surprise from the market. Surprise is what drives sharper pricing. Once the surprise is gone, the selling pressure tied to it tends to fade as well. The second was a wave of forced selling originating from leveraged positions in Asian markets, the kind of mechanical liquidation that happens when borrowed money meets a falling price and margin requirements force an exit regardless of underlying conviction. These events are real, and they are painful, but they are also, by their nature, temporary. Once the positions are closed, the selling pressure they create disappears with them. The third was simple calendar mechanics. Many large funds adjust their holdings at the end of each quarter, selling and buying not because of any new belief about the future, but because internal mandates require rebalancing on a fixed schedule. That pressure, too, has a defined endpoint. All 3 of these forces were scheduled to conclude at almost exactly the same moment. The close of trading on Monday, the same day that delivery obligations on the July silver contract officially opened, the same morning that oil markets would be absorbing, for the first time, the full weight of a weekend in which 2 nations had exchanged direct military strikes for the first time since their ceasefire had been signed. 3 numbers deserved attention above all others as that session approached. The price of Brent crude oil at the opening of Asian trading, since markets had not yet had the chance to price in the weekend's exchange of strikes. A move meaningfully higher than recent levels would begin to unwind the entire argument that had pushed the dollar to a 1-year high and dragged metals lower with it. The registered vault total reported before the start of the trading session in the United States. A meaningful drop from recent levels, combined with open interest still measured in the thousands of contracts, would signal that physical delivery pressure was no longer a theoretical concern, but an active, unfolding event. And the dollar index itself, the underlying engine behind nearly every other move described here. A break lower, in response to renewed conflict, would suggest that the very mechanism pressing precious metals downward for 2 weeks had begun to reverse. Beyond that single session, 2 further dates remained worth tracking. A government announcement expected within roughly 2 weeks regarding strategic mineral policy that could formally designate silver as a resource of national importance, and a window in late summer when naval clearance operations in the contested waterway were expected to finish, finally opening the route to the largest vessels still waiting offshore. None of these elements, taken individually, guaranteed any particular outcome, but taken together, they described something rare. A market where physical scarcity, geopolitical instability, and a hard delivery deadline had all arrived inside the same narrow window of time. Monday would not settle the long-term direction of silver, but it would offer the clearest signal yet of which version of this story the rest of the market was about to believe.